Welcome to the program. I'm Okpayemi Owosheni. We start off with business news. The Nigerian Senate has given the Nigerian National Petroleum Company Limited a one-week deadline to explain over 210 trillion naira in discrepancies found in its audited financial statement from 2017 to 2023. The ultimatum followed the Senate Public Accounts Committee hearing, where NNPCL's Chief Financial Officer Adedapo Olusegun faced questions over inconsistencies in record expenses and receivables. The chairman of the committee, Senator Aliyu Wadada, expressed strong dissatisfaction over the inconsistencies, particularly the record expenses, describing them as unacceptable. Now, reacting to the allegations, NNPCL CFO Adedapo Olusegun appealed for more time, noting that he had only recently assumed the role and needed to review the issues thoroughly.
Then 2023, 2019 was blank, 2021 blank, 2022 blank, and then 2023 899 billion, page 63. Now, questions as a result of what I read. What is the basis of this change loss charges deducted from our crude oil revenue? Can you explain to this committee how you charged or deducted 2.7 trillion as exchange loss against crude oil proceeds of only 3.6?
If there are questions that I can't answer, then the committee would have to kindly give me time to find the answers and come to you. I'm saying I'm on hold, and I have to say the truth and nothing but the truth.
The Bank Customers Association of Nigeria has reviewed that it has written to the Central Bank of Nigeria about the charges being deducted from customers' accounts. Now, this was disclosed by the president of the association, Uju Ogbunuka, at the 2025 Artificial Intelligence Conference, organized by under the theme Power of AI, Enhancing Efficiency and Customer Satisfaction for Better Financial Services and Experience. This disclosure comes amid an increase and a migration to the end-user billing model for unstructured supplementary service data from charges being deducted from bank account balance, a move which the association has faulted, describing it as falling outside the scope of bank charges approved by the Central Bank of Nigeria. We'll go on a break now and be back with company news. Welcome back. Now, telecommunication operators in Nigeria have agreed with banks and subscribers to deduct unstructured supplementary service data charges from airtime balances as approved by the Nigerian Communications Commission and the Central Bank of Nigeria. The new model, known as the end-user billing, allows mobile network carriers like MTN, Glo, Airtel and 9Mobile to eliminate banks as intermediaries and also deducts USSD service charges directly from subscribers' airtime balances. The arrangement came after mobile operators complained for years that banks were not remitting USSD service fees, which at some time mounted up to 250 billion naira before it was reduced to about 200 billion naira in 2024. And Zenith Bank has announced plans to fully exit its regulatory forbearance arrangement with the Central Bank of Nigeria by June 30th, 2025. Now, this was disclosed in a statement filed on the Nigerian Exchange Limited. Zenith Bank is one of the lead banks affected by the directive of the CBN freezing dividend payment, bonuses and investments in foreign subsidiaries over regulatory forbearance in respect to the single limit and other credit facilities. Now, in a statement signed by its company secretary, Michael Otu, the bank said it has successfully raised and surpassed the new regulatory capital requirement of 500 billion naira. We'll take a short break now, but when Money Matter returns, we'll be discussing on how CBN's 50% CRR policy is affecting Nigeria's banking sector and the economy. I'll bring you more details after this break. Welcome back. Now, ahead of next month's Monetary Policy Committee meeting, new research from Renaissance Capital reveals that Nigeria's banking sector is facing a severe liquidity crunch following the CBN's decision to impose a 50% cash reserve ratio. A move analyst says at odds with the country's ambition of reaching a $1 trillion economy by 2030. A new report by the investment capital has warned that the higher CRR requirement, described as the highest in the world, has significantly restricted banks' ability to lend, strengthening credit growth and turning market sentiment on Nigerian banks from bullish to bearish in the short term. Now, the CRR is a percentage of a bank's total deposits that must be kept with the CBN and not used for lending or investment. The Apex Bank had previously employed the direction in CRR debit, but it's still a shift to a uniform 50% requirement is now drawing criticism from financial experts and market analysts. Now, Nigerian banks lost about 840.2 billion naira in 2024 alone. That's nearly as much as 862.1 billion naira lost over the entire 2020 to 2023 period under the previous system. Now, let's unpack what this means for banks in Nigeria and Nigeria's economy generally. Economist Mukhtar Mohammed now joins me on the program. Thank you for joining me on the program, Mr. Mohammed. Now, I would like to know what's your take on the CBN's decision to set CRR at 50%. Do you think it's a necessary move, especially at a time when Nigeria currently needs credit growth?
Well, again, you have to look at it which way. If you look at what the CBN have been trying to do, they have two masters. They're looking at inflation, they look at growth. And so they look at, if we tackle inflation, indirectly we'll be building up growth. So I think basically they are looking at the inflationary issues. Now, to guide against it, because this current CBN government, our management team are involved in what they want to do is that they try to see how they can use the orthodox monetary policy tool, which is moreover when you have inflation, you reduce liquidity in the system. I think that's what they are trying to do to make sure that some of the banks lend to the real sector. I don't think so yet, because again, there are a lot of challenges that are going because of non-performing loans. So sometimes these banks look for income tax of investment, just putting in income pay, government security. That seems to be what is in the. So I think with the CBN looking at that, also they are looking at ways whereby they can deal with inflation, because as long as these inflation challenges are not curtailed, they will not attract foreign investors, they will not attract foreign portfolio investors, they won't attract foreign direct investors. So I think they are looking at that, they are taking it step by step. I believe that after you've been able to deal with inflation, then you begin to think about growth. And this is where some of the policy that would galvanize credits to the real sector will begin to tick in.
Now, according to a report by Renaissance Capital, banks lost over 840 billion naira in income in 2024 alone, and that's due to CRR more than the losses in the 3 previous years when combined together. Now, do you think this policy will affect banks' ability to lend and also support economic activities in the country?
Of course, yes. And I sometimes I wonder why the CBN just want the bank to just keep those money. And before it used to be 35, they want to up it to 50. For me, I think it's better you see those money goes to the real sector. But like I said, how many banks are ready to lend to the real sector? That's another challenge altogether. Because again, like I just mentioned to you, when you look at bank lending to the real sector, you look at the non-performing loans, you look at the microeconomic space, it's so volatile. They have to bring returns to their shareholders. They have to look at the risks involved in lending. So I think most banks are looking at the risks involved in this lending issue and begin to definitely, like I said, most of them are not lending to those smaller business that are employing over 60 to 80% of Nigeria. They're lending to the already established businesses. And even with that, they still struggle in terms of the payment of this loan, because of you and I know what the challenge we have in the microeconomy.
Now, there have been talks about the CBN recapitalization goal for quite a time now. Now, do you think this contradicts the CBN recapitalization goal? Is this something you agree with?
Well, when you look at recapitalization, recapitalization is a broader. Remember why are we recapitalizing? We are recapitalizing because we are trying to build a 1 trillion economy. We are also recapitalizing because we want our banks to be stronger. We're also recapitalizing because we think we want our banks to be immune to any systematic issue that will come as a result of the devaluation of our currency. We're also looking at our banks being more stronger in terms of handling a lot of issues that have to do with the microeconomic space. So it's not, the recapitalization is not just geared towards lending. Lending is part of it again, but they are guiding against systematic shock, like as I've just mentioned. So if you put lending as one of those major issues that is making the banks to, the CBN asking the bank to recapitalize, you may be losing the bigger picture, which is more or less like they want the banks to be able to handle high ticketing deals, which also you could say also would involve or the real sector that you want them to lend to. But now I think the recapitalization drive is a bigger picture, just rather than just lending to the real sector. I think it's all about the recapitalization of banks. It's all about stability, making sure that we have stability in our financial sectors.
Like you mentioned earlier, Mr. Mohammed, is definitely going to affect the economy. But now, I would like to know what sectors of the economy in particular do you think would feel the impact of reduced credits the most?
Okay, I said, the sectors that will be largely impacted by that. Mostly is the real sector, the manufacturing sector especially. They would definitely be those. They would be the one that is largely impacted by that. But also, you also have to look at the service sector. Also, they will be impacted by that because the service sector is already suffering as a result of the devaluation of the currency. So they also will be affected by that because the service sector is one sector that virtually all businesses in Nigeria has one or two dealings with them. So definitely that sector will suffer also. But mostly, I think it will deal with the manufacturers because, again, they seems to be the one that need a lot of credit to drive growth and also expand to other parts of the country.
So one thing the Nigerian government has been speaking about for a very long time is achieving a $1 trillion economy by 2030. Now, seeing that the CRR is like a very big thing, do you think this can be a roadblock to Nigeria's ambition of reaching a $1 trillion economy by 2030?
If you ask me whether we'll get a $1 trillion economy, I'll tell you that it's going to be a mirage in 2030. Because for us to get a $1 trillion economy, we have to be doing a GDP of double growth, at least GDP of 10%. And what we are doing now is about 3.7. Even if you project to 2027, 2028, we are not going to be doing above maybe 5 to 5 point or 6 point something percent in terms of GDP growth. So that already is a major challenge. We say things and we don't have the structure to back them up. So this issue is part of it because, like you rightly pointed out, if you are not lending to your real sector due to microeconomics decisions, because these are not just microeconomic decision, but monetary policy decision. Because you have the challenge with microeconomic decision, which has impeded growth in those sectors. Now you are adding to that, you are adding monetary. We are looking at the monetary side also adding to that challenge. So it will be very, very, very difficult for us to meet that. It's not just because of the cash reserve ratio alone that will not be able to meet that. It's all encompassing all of the issue, microeconomy, then that is there. Now the monetary policy issues also that is there. And when you look at bring those two together, like I said, GDP growth must be 10%. You have to be lending to your real sector, to your most productive sector, which is the informal sector. And if you're not ready to lend to the informal sector because of the risks that are involved in it, then definitely I don't think we'll be able to get to that. For me, as I sit here, 2030 is still far. It's still a little bit far. But in economies, no years are not far because if you look back, Vision 2020, Vision 20, housing for all, the year 2000, and all the kind of policy we have tried to push out, and at that time, it looks like a long time, but now most of those years have come and gone.
But let's now talk about reducing it. We've spoken about the increase, but then it's not something I say that you agree with. Now, do you think reducing the CRR would actually improve liquidity and lending significantly? That's for banks in the country.
No, it will not. I've said it. It will not improve liquidity. It will not improve lending. Like I've said, most of banks are looking for safe havens. because of the microeconomic issue and the monetary policy issues. So most banks are not looking at improving lending to the real sector. They are looking at stability. First, to be able to stable, you talked about the recapitalization of the bank. Most banks are looking at recapitalization. Like I said, if you look at the banking sheet that has come out, you look at the non-performing loans from the banking sector, you realize that there's a big challenge to most of the banks in terms of those loans. Some of them are making provision for it, and making provision for it doesn't mean that at the end of the day you are going to be able to achieve it. So for me, I think we need, where your question is a no-brainer. It will definitely have impact on the sector that you just mentioned.
Now, how do you think the CBN can balance financial stability with the need for economic growth?
Well, you see, you seek financial stability and economic growth when you look at a developed economy. Now, in a developing economy, you will not be able to achieve that at a go because of other challenges that normally come up. Some of these challenges are not necessarily challenges that are caused by you. Now, let me give an example. You look at the volatility in terms of oil production. Now, oil production has gone up. Then you have a challenge of meeting local production. Then that means your local company will have to import, and then you have the FX challenge also. These are things that were not planned for. Now, because of the Iran and Israeli war, you are beginning to see those challenges. Then you could also face challenge of, because most developing economy are monotonous in terms of mineral resources. They have one major mineral resources that bring FX. And sometimes these resources are not controlled by them. So when you have those challenges that have to do with price depreciation, then it tends to affect them. So balancing it is always a struggle. But what you do is you pick one. First of all, most developed economies look for financial stability first. When you have financial stability, you are able to attract the right investors. Once the right investors begin to come into the market, then you begin to look at growth. So it's always difficult for a developing economy to be able to manage financial stability almost at the same time as economic growth.
Now, what reforms would you recommend to improve credit availability without compromising financial stability?
I think we have to go back to that issue that we've always talked about. Maybe direct intervention, but in direct intervention, we need to look at structures. We need to look at our key drivers that can earn us more effects into the economy. And we need to look at what are the structures that we need to put on ground so that when those direct intervention will be felt and then we'll see it in those businesses. I think that is what we need to do to build growth. Like I've told you, Nigerian growth, and if not also growth, employability, I'm largely driven by the informal sector. Now, for you to measure growth of sector, there are a lot of things that you need to do. Number one, you need to think of stable electricity, which is power. That has been a major challenge for a while. So we need to think about that. How can we bring stability in terms of into the power sector and also be able to generate more? That is one. Secondly, also, we also have to look at the exchange rate. The volatility of the exchange rate is also a major challenge. Then we also have to look at this orthodox monetary policy too. Is it really working for us? Will it really work for us as a nation? Do we really have those kind of challenge that have to do with supply distortion? But our challenges are also challenges that have to do with the precarity of our environment. Infrastructure, we need to build infrastructure. That is key. We need to see how goods should move from point A to point B. We need to also improve our tax system, not just only looking at levies. We need to begin to see tax as a means of growing our economy, either to attract the big players or to also act as a means of cost control to smaller business, whereby smaller business are not paying so much in terms of levies that will make it impossible for them to pay taxes. This, what I've just mentioned, are structural reforms, and these reforms will need constitutional backing to be able to carry it up. So I think those are part of what I would recommend so that we can be able to come through both with growth and stability. And also, we must not forget one key factor that will drive foreign investors into your market. It has to be the rule of law.
Now, just before I let you go, Mr. Mohammed, the next MPC meeting is in July. That's in about 2 weeks. Now, I would like to know, what policy would you recommend urgently that before the MPC meeting, during the MPC meeting, and after the MPC meeting to make the economy better than it is at the moment?
think I'll have to wait for the MPC meetings and see where the exchange rate is at the time they will be meeting for the meeting. And if at the time they are meeting for the meeting, the exchange rate has improved, then I will say, okay, can we work it down a little? Because I still strongly believe that the inflationary pressure that we are facing as a nation is largely driven by our exchange rate volatility. That is one. I would say CBN still concentrate in seeing how you can bring down exchange rate so that in doing that, you will be able to address the inflationary pressures that have always impacted on our livelihood as a nation and also at businesses. That is one. Secondly, I will also be telling them that, look, if macroeconomic issues are stabilizing based on what the Nigerian Bureau of Statistics has said, then you need to bring down rates so that cost of borrowing will come down for smaller businesses so that they will be able to borrow and also be able to pay back. And so that's on that thing I will be telling them to be doing. And I'm saying lastly, again, I'll be telling them to look at key sectors whereby you can intervene that will bring the desired change into the microeconomics climate, and also make sure that your policies are always in synergy with what the monetary side are doing.